Buddy, it's Brian Shannon from AlphaTrends.net. Today is Friday, the 3rd of March, 2017. Hope you had a decent week of trading. For the markets, we were mainly positive this week. You can see here that oil and bonds lost ground once again. And the Russell 2000 continues to be the laggard this year, only up a little less than 3% year to date compared to the NASDAQ, which is up close to 11%. The Biotech's up 14%. So let's take a look at the charts and see where we are and what we have the potential to do from here. If you recall, a couple weeks ago, I had mentioned the upside objective from a measured move at 242.50, and we're closing in on that. This week, we closed at new all-time highs for on a weekly basis, that is, and 2 days of a little pullback here. It certainly does nothing to interrupt this longer-term bull market that we're in. On the intermediate-term time frame, we came down right to that rising 5-day moving average and found support in there today. From the gap 3 days ago, though, we are below that volume weighted average price, saying that there's been some profit taking into that gap. But for the week, we did close pretty much right at the volume weighted average price. So we remain in a firm uptrend on all time frames, except of course maybe the last 2-3 days. But next week, what we'll be looking for, we're going to continue to give the benefit of the doubt to the buyers, and we'll be looking for our initial level of support to be found near this level, and then down near about 236, 235.75. I think that 235.75 will be an important level if we drop down towards that level. I would not expect a big breakdown through that. So just be careful, obviously, about buying extended stocks. And as always, your job remains to be a risk manager, to manage risk and find the low risk, high probability trades. And that's what we look to do each and every day at Alpha Trends. QQQ, the NASDAQ 100, this market, as I pointed out this week, did meet pretty much to within a couple pennies of its measured move objective, taking point A down here, the height of point A to point B, and adding that to point C right here, gave us our upward target up in here, which was breached by about 3 cents on Wednesday. And since then, we've pulled back a little bit, but clearly no damage done to the overall trend. We closed above the volume weighted average price for the week. We closed above the 5-day moving average. And this is going to be right in here, this box that I have. This is our first level of potential support. If it breaks below that, then perhaps we see a move down towards 129.50. 129.50 would not be a bad thing. That's probably going to be caught at the 20-day moving average, which is rising. But obviously, again, the market's a little bit extended here, and you have to be careful about what you're buying. One that we got involved in actually on Thursday and then did not hold it because of the earnings report that were due this morning was NTNX. Now, we bought NTNX on Thursday, right in this area, and we got out before the close because we didn't want to have exposure to the earnings report, and that's something that you can look at and see was a good decision. Not one single person who bought the stock since coming public is making money, unless they bought it right down here in the last 20 minutes of the day. But risk management is always job number one, knowing what the catalysts are, such as an earnings report, and deciding that it's better to stand aside was clearly a good decision in there. And you talk about stocks like VRX that continue to be hammered, closing at a new low. Since this debacle began. And again, people have been calling a bottom all the way down. If they don't scare you out on the way down, they'll typically wear you out. We're below a declining 200-day moving average, meaning institutions on net are continuing to be sellers of this stock. Therefore, there's no reason to be a buyer of it unless you're just looking for short-term trades. The Russell 2000 has been a little bit of an underperformer recently, as I've mentioned, but it's still, it's holding above that 20-day moving average on a closing basis, and it's closing above this prior little band of resistance in here. So it's not a damaged market. You look at the 30-minute time frame here, and we can see that we are below the 5-day moving average, but it's just doing a whole bunch of nothing in here. This is the key band of support that we want to continue to see hold. If we break below and stay below that 137 and a quarter for more than a half hour or so, then I think we're most likely going to test that 50-day moving average, and that may put a little bit of pressure on the broader market as well. So know where the risks are and what your potential is for risk, and decide where to place your stop based on that. The semiconductors have, as we know, we've talked ad nauseum about how long they've been strong and continue to be strong, and that they continue to defy the short sellers who are just being tormented by higher prices over and over again. Now, we're still above a rising 50-day moving average on that daily time frame, says innocent till proven guilty from a longer term perspective. Intermediate term, we're starting to see a little bit of maybe sideways action in here, but we still have a very strong, healthy group here with these semiconductors going back to the February moves. I mean, maybe we come back down towards this area in here where 75-75-ish, but I still don't think that would do any real damage to the overall trend. And, it's likely to be caught by that rising 50-day moving average if it continues at that pace. The biotechs, we saw that they had initially found a little bit of resistance at that breakout point, and this was a breakout from the range that it's been in for more than a year or so. And as I always caution, if you're going to be the person that buys a breakout, you have to ask yourself, where has it come from? And certainly buying a breakout after a move that we had seen here from 286 up to 302 to break out doesn't make a whole lot of sense. But on a 30-minute time frame, we were already in this uptrend. We were making higher highs and higher lows above a rising 5-day moving average, and this market is now starting to slow down in this area. From a bigger picture perspective, as we've noted, the volume weighted average price from the peak, we closed right at that last week, and this week we are now closing above it. And what we would like to see is that 290 to 295 becomes our important level of support for this market. If it can continue to hold above that level, then I think that the biotechs are most likely due to accelerate to the upside. You look at a stock like Celgene, CELG, which is in this much longer term uptrend. And obviously, the pullback in here was nothing compared to the broader index that it's involved in, the biotech group. But on the weekly time frame, we're showing that the stock has found support along its longer term rising moving averages. This green one is the 40-week or 200-day moving average, and then going down to a shorter term time frame with a 10, 20, and 50-day moving average. You can see we broke a little resistance this week. That resistance held as support along a rising 10-day moving average. And I think this is the type of stock that if it can get going, perhaps above this little peak with a stop under here, that might be one way to trade it depending upon your time frame. But biotechs are clearly a group that look like they've got good things coming for them, in the intermediate term future. It will depend, of course, as always, if they can hold up above the key levels. And as I mentioned, I think that probably 295 is going to be that level that we'd like to see hold. If it pulls back down to there, I don't think it would be a big deal, but it would instead, if it were to drop down towards there, and then the 5-day moving average comes around like this, and then we're able to get back up above this level, that would present an excellent buying opportunity. Similar to, this is where it looks like we are right now for these biotechs. If you look at where we are here and compare it to maybe something that looks like this, right around in this area. So certainly a little bit more pullback and then rally would be the proper way, I think, to get the long exposure in there. Last week we spoke about bonds and the fact that they are guilty till proven innocent, that the best case scenario is that they are creating a sideways range here, and that maybe they would rally up and then find support in the middle point of that range. Obviously, they just gapped down, continued lower. Bonds are dead money here. If you like just watching your money go sideways, then a good place to put your money. But right now, we continue to be trying to find support, and very similar to VRX, here's a stock that people get excited about when it gets above the 50-day moving average, but the longer term trend is still lower in this stock, and says that there's probably pain ahead. Now, I wouldn't short VRX here. It was down 20, close to 25% this week alone. So asking yourself again, where has it come from? Does the risk, look good relative to the potential reward? At this point, I'd say no. I think you need some kind of rally up, and then that rally to fail to hold, and then you would short it. But just again, if they don't scare you out on the way down, they'll typically wear you out. Taking a look also at some other ideas that might have a decent opportunity for some upside next week. We've got ATVI. This stock has held up very well. Here's the weekly time frame. On the daily time frame, you can see that it broke some resistance here this week, and it is so far consolidating nicely through time, and perhaps above today's high, we would see some momentum continue back into this name with a stop under here, which is below today's low and where we see approximately that rising 5-day moving average. Other names that I would say you might want to keep an eye on would include, of course, that Celgene. Nvidia is, it's broken right now from an intermediate term perspective. We'd spoken about the volume weighted average price from the November 11th gap higher, and that we are now closing below that, and the volume weighted average price since the most recent earnings report as well. We've been stuck below that volume weighted average price, showing that the sellers are more aggressive in here, and that it may need some further pullback or time to consolidate. But right now, with a stock below its declining 5-day moving average, there's no reason to be looking for a long side trade in here unless you're just looking for these short-term bounces, which of course can be quite rewarding. But the structure says that it's not ready to sustain an upside movement from an intermediate term perspective. Another name that kind of catches my eye is Wynn Resorts. Wynn Resorts, if you look at the weekly time frame here, we had clearly a stage 2 uptrend with higher highs and higher lows, and then it went to a stage 3 distribution. It broke below that stage 3 distribution low, and then made a pattern of lower highs and lower lows below these longer term moving averages, and then it turned sideways in here, rallied up, and now for the last year it's just been kind of trading in this box here. Now it looks to me like this is the type of stock that if it can hold up in here, that we would be looking for it to possibly continue to move higher. We had a shakeout low here, then we had a higher low on this weekly time frame, and then 2 weeks ago we had another higher low. All these longer term moving averages are flattened out, and they look like we've got a little bit of resistance right up in here, and then the bigger area up near 110. But I think that next week, if you can get it back above this initial level, it's something that's definitely worth keeping an eye on, because energy is building as we rally up to this first little level of resistance. And you could say, well, doesn't that look like a cup and that looks like a handle? Well, the point is that more repeated test of resistance tends to overwhelm the supply in that area, and it shows that the buyers are being more aggressive by getting by working through that supply. So price wise, the time between these tests is minimizing, and we also have the higher lows saying that the buyers aren't waiting for a pullback to 85 or 87 or 94 to get control. Instead, they were hanging on to that control, and it's setting up Wynn as a possible upside breakout. It's been a large underperformer for several years. It's built a nice base, and maybe this is a good one for next week. Anyways, if you don't follow me on Twitter, I think you should, because I put a lot of stuff out there each week, and a lot of people who follow me just on YouTube are not seeing that. So follow at Alpha Trends on Twitter, and have a good weekend. Thanks for tuning in.